Well, there's been a lot of talk lately about the COMEX possibly defaulting in May because open interest looks bigger than the silver sitting in the registered category. So in this video, we're going to separate the scary headline from the real market plumbing, and you're going to walk away feeling a lot smarter, a lot calmer, and a lot harder to push around with panic posts. Today is Tuesday, April 28th, New York time. Comment below what day and date you're watching from. And if you value this kind of calm breakdown, subscribe to support the channel and comment John AG best. So I know you want real analysis, not recycled fear. So the viral version sounds simple. There are a little over 100 million ounces connected to May open interest, and only somewhere around the high 70 million ounce area showing as registered silver. On the surface, that sounds like a math problem. It sounds like more claims than metal. It sounds like the exchange is standing in front of a vault with an empty clipboard. But this is where we have to slow down. Because open interest is not a line of people demanding bars. Open interest is simply the number of open futures contracts still alive in the system. Some are hedges, some are spreads, some are speculators, some will roll, some will close, some will offset before delivery becomes a real question. So if someone takes the whole open interest pile and treats it like immediate physical demand, the chart can look explosive, but the logic is already bending. And here's the important part. That does not mean silver is weak. It does not mean the paper market is perfect. It does not mean there are no stresses building underneath the surface. It just means the shortcut math is not enough to prove a default. That's the distinction. Silver can have a powerful long-term bullish case, and the COMEX fails in May story can still be overstated. Both things can be true at the same time. Now let's start with the bigger picture. Based on recently published numbers, the silver market is still expected to run another sizable annual deficit, with industrial demand near record territory and total demand still sitting around the billion-ounce neighborhood. That matters. It means the physical market is not swimming in endless new supply. It means solar, electronics, auto electrification, artificial intelligence hardware, and safe haven demand are all competing for the same metal. But a structural deficit is not the same thing as an exchange default next week. That is where investors get trapped. They start with a real long-term issue, then jump to a very specific short-term prediction. They say, silver is tight, therefore May must break. No. Silver may be tight, and May may still settle normally. Silver may reprice over time, and the exchange may still survive this delivery cycle. Markets can be frustrating like that. So, let's talk about what registered silver actually means. Registered metal is the category already available for delivery through the exchange process. Eligible metal is different. It meets the right standards, but it does not currently have the delivery warrant attached. That means eligible silver is not fake supply, but it is not guaranteed supply either. It's like a house that could be listed for sale but isn't listed today. If spreads get attractive enough, if the owner wants the return, if the economics work, eligible silver can move into registered. If the incentive is not there, it can stay parked. So anyone saying registered inventory is the absolute ceiling is oversimplifying it. But anyone saying every eligible ounce will instantly convert is oversimplifying too. The truth is conditional. And conditional truth doesn't go viral as easily. Now add another layer. Global arbitrage. Silver does not live in one warehouse. It moves between New York, London, Shanghai, refiners, vaults, dealers, industrial users, and investors. It does not move instantly. It does not move for free. But when price spreads become attractive enough, metal starts looking for a path. This is why supply is fixed is a dangerous phrase. Mine supply is slow? Yes. Refinery capacity is limited? Yes. Approved bar standards matter? Yes. But above-ground silver can respond to price. Dealer inventory can change. Retail holders can sell. ETF flows can shift. Eligible metal can become registered. Regional premiums can pull metal across markets. So the market is not a frozen picture. It is a moving system. Now, let's get to delivery, because this is the part many people misunderstand. A delivery on COMEX does not automatically mean a truck backs up to a vault and hauls silver away. Very often, delivery is a transfer of title. A warehouse receipt changes hands. Ownership moves from one party to another, while the metal can remain in the same approved facility. Think of it like changing the name on the deed, not moving the building. That matters because if you count every delivery as physical silver leaving the system, you can scare yourself with a number that doesn't mean what you think it means. A lot of delivery activity can happen while the actual bars sit right where they were. Again, this is not a defense of every exchange rule. It is just how the machine works. And if you're going to predict the machine breaks, you should understand the machine first. A futures exchange is not a coin shop. It's not a dealer counter where every buyer walks in for immediate product. It is a risk transfer market. Miners use it, refiners use it, industrial users use it, banks use it, funds use it, speculators use it. Some participants want price protection. Some want leverage. Some want arbitrage. Some actually want delivery. Most do not. That last sentence is the whole issue. If every contract holder demanded silver at once, yes, the system would be in trouble. But that's like saying if every bank customer demanded cash on the same morning, the bank would have a problem. True. But that is not the same as proving it happens tomorrow. So what would real stress look like? We would not just see a screenshot with scary columns. We would see lease rates screaming. We would see spreads behaving abnormally. We would see backwardation that sticks. We would see physical premiums in major hubs widen in a way that cannot be easily arbitraged. We would see ETF flows, vault data, refinery delays, and regional shortages all pointing in the same direction. In other words, we need confirmation. Not one chart, a cluster of evidence. From recent market updates, there are real reasons to watch silver closely. The official contract structure requires exchange-approved high-fineness silver in specific bar form, and delivery timing follows defined exchange rules rather than social media countdown clocks. That is why the bar type, the warrant, the date, the holder's incentive, and the market spread all matter. Now, does that mean nothing can go wrong? No. Extreme market events happen. Forced cash settlement, rule changes, delivery strain, and confidence shocks are all possible in theory. But possible is not the same as probable, and probable is not the same as guaranteed. That's where the internet often skips 2 steps. It turns could happen into will happen. Then it turns will happen into by next week. And once that deadline is attached, people start taking risk they would never take if they were thinking clearly. And this is where I want to be careful. There is a real bullish case for silver. The world is carrying heavy debt. The U.S. public debt is now around the high $30 trillion zone. Inflation has cooled at times, but it has not disappeared from people's lives. Tariff uncertainty, energy volatility, supply chain changes, and central bank demand for hard assets have all kept investors interested in metals. That backdrop matters. But you do not need COMEX to fail for silver to matter. In fact, building your entire silver thesis on an exchange collapse is risky. If your plan only works if a crisis hits on one delivery month, that's not really a metals strategy. That's a bet on a very specific failure. A stronger thesis is broader. Silver has monetary history. It has industrial necessity. It has supply limitations. It has investment demand. It sits inside a world where trust in paper promises is under pressure. It also has a futures market that can amplify both calm and panic. That's enough. You don't have to force a default story on top of it. Now let's talk about price action. When silver runs hard, people naturally start asking, was that the move? And the honest answer is, we don't know. A market can rise sharply, then spend months building a base. That base can feel boring. It can feel disappointing. It can make bulls question themselves. But sideways action does not automatically kill a bull market. Sometimes it is digestion. Sometimes it is distribution. Sometimes it is just the market making everyone uncomfortable before the next decision. So instead of demanding an immediate explosion, watch how silver behaves during the pause. Does selling get absorbed? Do premiums stay firm? Does industrial demand keep showing up? Do miners confirm? Do ETFs attract metal? Do spreads tighten or loosen? That tells you more than another countdown post. And here's the skeptical point. Higher silver prices can bring supply back. Retail investors who held through lower prices may sell coins and bars when prices jump. Dealers may see product come back across the counter. Some of that goes straight back to retail buyers. Some goes wholesale. Some waits for refining. Some gets turned into commercial bars later. So price strength can create its own temporary relief valve. That does not destroy the long-term case. It just means the market breathes. It inhales demand, exhales supply, and then decides what the next level really is. If you're successful, share your success story in the comments so others can stay motivated. But also share what you learned, because in markets, surviving the hype matters just as much as catching the move. One more thing most people miss is the difference between exchange-grade silver and all the silver that exists in the world. Silver in jewelry, tableware, scrap, small retail bars, old coins, industrial material, or non-standard form is still real silver, but it is not always immediately usable for a futures delivery. It may need sorting, assaying, melting, recasting, paperwork, transport, and approval before it fits the delivery channel. That lag is important. It means the market can be tight even when silver exists somewhere. It also means a high price can gradually unlock supply that was not available yesterday. This is why you should avoid both extremes. Don't believe the system has unlimited metal. It doesn't. But don't believe every ounce outside registered inventory is useless either. It isn't. The official daily stock reports also matter because they remind us that these categories are reported and watched, not guessed in secret. You can disagree with the system. You can question incentives. You can argue that the rules favor large players. Fine. But when analyzing stress, use the actual warehouse categories, delivery rules, open interest, spreads, and price behavior together. Don't just grab the most dramatic number and build the whole story on it. That's not analysis. That's theater with a calculator. And another clue is how professionals behave before delivery. Serious players know notice periods. They know last trade timing. They know financing costs. They know whether it makes sense to stand, roll, exchange for physical, or close out. Retail panic often treats these dates like surprise traps, but the people actually using the market have been preparing for them the whole time. So a deadline by itself is not the crisis. The behavior around the deadline is the evidence. That's why I would rather be early with understanding than early with a panic trade. Understanding lets you adjust. Panic locks you into a story. And once you're emotionally married to a deadline, every piece of contrary evidence starts feeling like an attack instead of useful information. That's a dangerous place to be with real money on the line, especially in volatile silver markets. Now cash settlement. This is another phrase people throw around like it automatically means the apocalypse. But contract rules matter. If the rules allow certain settlement paths, then the word default becomes more complicated than a headline suggests. Would forced cash settlement damage confidence? Absolutely. It would be a serious signal. It could make people question not just silver, but the broader futures pricing system. And that's exactly why it would not be used lightly. A true confidence break would be much bigger than registered ounces versus open interest. It would be about whether hedgers, producers, users, banks, and investors still trust the pricing mechanism. That is a systemic issue, not a spreadsheet issue. So how likely is an imminent May default? In my view, very low, not impossible. Never say impossible in markets, but low. The better base case is that the fear cycle repeats, contracts roll or settle, some delivery happens, some title transfers, some metal moves, and social media moves on to the next deadline. That sounds less dramatic, but it is probably closer to how these markets actually function. So what should you watch instead? Watch lease rates, watch backwardation, watch regional premiums, watch actual withdrawals, not just deliveries, watch eligible to registered movement, watch ETF flows, watch refinery backlogs, watch dealer buybacks, watch whether industrial users begin acting nervous, watch whether price rises are pulling in supply or exposing shortage. Most importantly, watch your own emotions, because panic posts are designed to make you feel late. They make you feel like you have one last chance before the door closes. But good investing doesn't come from panic. It comes from process. So where does this leave us? The silver story is still alive. The long-term case may even be stronger than many people think. But the immediate COMEX default narrative needs a much higher burden of proof. One scary comparison is not enough. A real crisis would show up across multiple indicators, in multiple regions, through pricing behavior, delivery behavior, premiums, spreads, and confidence. Until then, stay alert, not emotional. Silver does not need a May default to be important. It just needs time, pressure, demand, and the kind of monetary backdrop that keeps reminding people why real assets exist in the first place. Subscribe if you want more calm market breakdowns without the panic theater. And comment below, do you think silver's next major move comes from industrial demand, monetary fear, physical shortage, or something nobody is watching yet? As always, this is for education and market discussion only. It is not personal financial advice. I'm not telling you to buy, sell, or hold anything. Use this as a starting point, check the data yourself, understand your own risk, and make decisions that fit your situation.